Welcome back to the LeverUp AMA series. I'm Marcus, and today we're covering one of those concepts that every perp trader has heard of but most people half understand, the funding rate. My guest is James from the LeverUp team. James, thanks for being here.
Good to be on. And you're right, funding rate is one of those things where people think they get it and then get surprised by it mid-trade. Worth unpacking properly.
Let's do it. Start from zero. What even is a funding rate?
At its core, it's a periodic payment exchanged between the long side and the short side in a perpetual futures market. When longs outnumber shorts, longs pay shorts. When shorts outnumber longs, shorts pay longs. That's the simplest version.
And why does it need to exist at all? Normal futures don't have this.
Exactly right, and that's the key insight. Normal futures contracts have an expiry date. When the contract settles, it settles at the spot price, so by design, futures price and spot price must converge at expiry. That natural convergence mechanism doesn't exist in perpetual futures. A perp has no expiry, so without some other mechanism, the perp price can just drift away from spot and stay there indefinitely. The funding rate is what replaces expiry. It's the anchor.
Okay, so walk me through the mechanics. Say Bitcoin spot is trading at 100,000 and the perp is trading at 100,200. What happens?
The perp is at a premium to spot, meaning there's more buying pressure on the perp side than on spot. In that situation, a positive funding rate kicks in. Long traders start paying short traders a periodic fee. That does two things simultaneously. It raises the cost of holding a long position, so some longs close or don't open. And it rewards the short side, so more short interest comes in. Both effects push the perp price back towards spot.
And the opposite, perp trades below spot.
Then you get negative funding. Shorts are paying longs. The perp is at a discount, usually during heavy bearish sentiment, and the mechanism works in reverse. You're incentivizing longs to come in, disincentivizing new shorts, and the price gravitates back towards spot.
Is the rate fixed? Like, is it always the same percentage?
No, and this is important. The rate scales with the size of the imbalance. A small premium between perp and spot produces a gentle correction signal. A large premium produces a much stronger one. The bigger the dislocation, the more aggressive the funding mechanism becomes to pull things back.
Let's talk cost. I think a lot of traders underestimate what funding actually takes out of them.
It's genuinely one of the most underestimated costs in perp trading. And the main mistake people make is thinking about it relative to their collateral when they should be thinking about it relative to their notional position size.
Break that down.
If you deposit $100 of collateral and go 50x leverage, you're not holding a $100 position, you're holding a $5,000 position. Funding is calculated on that 5,000, not on the 100. So even a small-looking funding rate becomes a real number when you're running high leverage over multiple funding periods.
So the number in the interface isn't the cost to you. It's the rate applied to a much bigger number.
Right, and the other thing that catches people is duration. Funding is a time-weighted cost. A position held for a few hours in elevated funding is manageable. A swing trade held for a week in strongly positive funding can accumulate a cost that exceeds your entry and exit fees combined. It's one of those costs that doesn't feel like much on day one and then quietly eats into the position.
So the questions to ask before you enter a trade are, what's the current rate? How long am I planning to hold? And what does that actually cost me at my notional size?
Those three questions, yes. And add a fourth, is the rate likely to stay at that level or is it in a direction that might shift? Because the rate at entry is not locked in. As open interest moves, the rate adjusts. A trade that looks cheap to hold today can get more expensive if the market continues leaning in your direction.
This brings me to the part I think is actually the most interesting. using funding rate as a market signal, not just as a cost, but as a read on positioning.
This is where it gets useful beyond just cost accounting. The funding rate is essentially a real-time measurement of how crowded a trade is and in which direction.
So high positive funding, what does that actually tell me?
It tells you the long side is significantly outweighing the short side. There's heavy directional consensus toward longs. Now, and this is the nuance people miss, high positive funding is not inherently a signal to go short. Markets can stay crowded in one direction during a strong trend and sustain that for a long time. The funding rate doesn't predict when the trade unwinds.
But it tells you something about the risk profile of entering a long.
Exactly three things specifically. First, you're paying a premium to hold that long exposure. That's a direct cost. Second, if sentiment flips, the unwind tends to be fast and disorderly because everyone who built up that crowded long wants out at the same time. Third, the more crowded the positioning, the harder that flush tends to be when it comes.
And negative funding, crowded short.
Crowded short positioning. These conditions are often associated with short squeeze setups, especially when open interest is high and the market has been leaning short for an extended period. Again, negative funding doesn't guarantee a squeeze, but it's a warning that the short side is exposed if anything forces a reversal.
What about near zero funding?
Balanced open interest. Long and short sides are roughly equal, lower cost to hold either side, and no strong directional consensus embedded in the positioning data. From a positioning read standpoint, it's a neutral signal.
You mentioned open interest alongside funding. Talk about why those two data points work together.
Funding rate tells you the direction of the imbalance and what it costs to hold. Open interest tells you the magnitude, how much capital is actually deployed on that bet. They're complementary.
Give me the extreme case.
The most extreme risk condition is high funding in one direction and high rising open interest on the same side. That's the signal that says a lot of capital is piling into a crowded trade and the imbalance is still growing. When those two compress together, high funding drops and open interest falls simultaneously. It often signals a flush is happening or has already happened.
And the opposite, high positive funding but falling open interest.
That usually means long deleveraging is underway. Longs are exiting. The rate is still elevated because there's still an imbalance, but the direction of travel is toward unwinding rather than building. Different risk profile than the accumulation phase.
So you can't just look at the rate in isolation. You have to ask whether open interest is expanding or contracting in the same direction.
That's the full picture. One number without the other is incomplete context.
Let's bring it to LeverUp specifically. Does funding work the same way on LeverUp as it does on other perp venues?
The core function is the same. Funding keeps long and short sides in balance, but there are some meaningful structural differences.
Walk me through them.
On venues that use LP pools, the funding rate structure has to account for LP incentives. There's a layer of calibration around keeping liquidity providers compensated. On LeverUp, because we run a protocol-managed virtual liquidity architecture without external liquidity providers, the funding rate has one job: reflect the actual imbalance between long and short open interest. Nothing else is baked into it.
So it's a cleaner signal.
More direct, yes. The rate scales with the imbalance, incorporates historical volatility as a baseline. Higher volatility assets carry a higher base rate because the magnitude of potential price dislocations is larger and compresses as OI moves toward balance.
You also run what you call a cubic OI funding model. What does that mean in practice for a trader?
Under a linear model, the funding rate rises proportionally to the size of the imbalance. straightforward, but can produce elevated rates in conditions that are moderately imbalanced, but not severely so. The cubic model is gentler at lower imbalance levels. In balanced or moderately skewed markets, traders experience meaningfully lower cumulative funding drag across multiple periods. But the cubic scaling also means the model responds more aggressively to severe imbalances. The protocol doesn't lose its ability to correct large dislocations.
So you're paying less on the low end, and the system still responds hard when it needs to.
Correct, for swing traders holding positions over multiple funding periods in normal market conditions, that difference compounds into a real cost reduction.
One last thing I know on the LeverUp interface. Funding doesn't appear as a separate line item. You show something called holding fee.
Right, on LeverUp, the holding fee and funding fee are combined and displayed as a single line. The full breakdown of how both components are calculated is in the docs, but the interface keeps it simple, one number that represents your total cost to hold the position. That's what you factor into your trade planning.
All right, let me give people the summary. Funding rate is the periodic payment between longs and shorts in a perp market. It exists because perps don't expire, and without it the perp price would drift away from spot. When longs dominate, longs pay shorts. When shorts dominate, shorts pay longs. The rate scales with the size of the imbalance, not a fixed number. The cost to you is based on your notional size, collateral times leverage, not just the collateral you put in. High positive funding signals crowded long positioning. Expensive to hold long, and if it unwinds hard. High negative funding signals crowded short positioning and potential squeeze risk. And reading funding alongside open interest gives you the most complete picture of where the positioning risk is actually concentrated. On LeverUp, the cubic OI model means lower drag in normal conditions, and it all shows up as a single holding fee in the interface.
That's the full picture. Any of those points land and your trade planning improves.
James, appreciate you walking through all of it. For everyone listening, the full written breakdown of funding rates, including the FAQ and how to read funding alongside OI, is in the article on the LeverUp blog. Link is in the description. If you haven't read the Open Interest Companion piece yet, start there. These two articles work together. Thanks for listening.